Rajiv Malik, Senior Economist at CLSA, joins us a day ahead of Fed policy from Singapore. Rajiv, morning. Thank you for joining us. Rajiv, ETNA polls suggest that Reserve Bank of India will cut rates for the third time this year by 25 bips. Do you expect 25 or do you expect no change?
That's right. Obviously markets have flip-flopped since the last RBI policy statement in March, which was misinterpreted, at least in my opinion, to be less dovish. We have consistently maintained that at the annual policy this week, the RBI will come through with a 0.25 percentage point cut. I think there's less of a high probability of a CRR cut, simply because as government spending begins to pick up in the new fiscal year, LAF deficit should actually come down. So less of a compelling reason for the RBI to move on the cash reserve ratio.
Do you expect the RBI to turn dovish in the upcoming policy, looking at inflation data, CAD moderating with commodity cool-off that we've seen right now? Some sections in the market believe the cut could be as much as 50 basis points. Is it possible?
Well, 50 basis point reduction in the repo rate is always a possibility, but I struggle to find justification for it when CPI inflation, which everyone ignores in India, and I think even RBI tends to have more of a benign neglect for it, is running over 10%. It is absolutely amazing if a central bank can actually cut interest rates by 50 basis points when retail inflation is up in the stratosphere.
So Rajiv, will Reserve Bank of India follow with more cuts in subsequent policies, because there is another one due in June? And you mentioned about things bottoming out at 7%.
That's right. I mean, the way to think about longer-term trajectory is the kind of inflation forecast RBI is going to announce in its policy. And my own reading is this is going to be 6% for March 2014. Assuming a 1 percentage point premium on that gives us a 7% repo rate, roughly 50 basis points from here. Bear in mind, while in the very near term, inflation at the headline WPI level could be lower than that 6%, it does not necessarily mean each time that happens that RBI has to respond with a rate cut. So one of the elements in the guidance, while RBI will still maintain a pro-growth bias and welcome the decline in commodity prices and inflation, it will nevertheless still flag several risks to the inflation forecast, whether it's in terms of further requirement for revising up administered prices, the lack of adequate supply-side initiatives for a longer sustainable decline in inflation, or even in terms of guiding market expectations to a more sustainable inflation profile rather than just a volatile downward bias that we might see in the next few months.
Meanwhile, a liquidity deficit has been around 1 lakh crores. How do you see liquidity situation shaping up over the next quarter? Do you think RBI will continue to use OMOs to manage liquidity, or do you think there is a case of a CRR cut?
Well, there are three aspects to this particular issue. One is, why is the reported liquidity deficit so high? In our own senses, a lot of it has to do with the government's high cash balances with the RBI. So if you were to try and strip that out, the actual core liquidity is much lower. Because of that, I don't think there's really a justification for a cut in the cash reserve ratio. RBI is better advised to use open market operations to deal with that. Don't also forget that as we get into this new fiscal year, government spending is poised to pick up, which in turn will have a favorable impact in terms of lowering that liquidity deficit on LAF. Investors, bankers in particular locally, are always gunning for an easy way out. But this one, RBI needs to be fairly cautious because it can't be cutting the cash reserve ratio when the main reason for the high liquidity deficit has to do with government's cash balances.
Rajiv, there are expectations that inflation will start its up move in the next few months, and this will coincide with state elections. Do you think this is something which could restrict Reserve Bank of India going forward?
Well, I hope politics is less of an issue in RBI's, considerations as such. As I mentioned earlier, headline WPI inflation will clearly come off a bit more in the next few months before ticking up later in the year, which is precisely the point I was trying to make, that RBI can't necessarily just follow this volatile trajectory point for point. It has to see through it and think more in terms of its sustainable profile. Don't also forget CPI core inflation is almost double the pace of WPI core inflation. So, at least in my understanding, there's a genuine reason why the broader Indian public does not buy this argument that inflation is improving in India. It is improving at a WPI level. But if you're a household, that is not really what you're getting reflected with. It is to do with CPI inflation. And by now, some of these inflation expectations have become more entrenched. WPI reflects more commodity prices. Obviously, demand aspect is there, but heavily more influenced by tradables. Whereas there's something more sinister happening as far as non-tradables are concerned, which impact CPI a lot more, including elevated inflation expectations as such. So I think RBI should begin to give far greater importance to the CPI inflation number than it does. There is, after all, a reason why no other central bank in the region or even in the emerging market world ignores the CPI as much as the RBI does.
Does lower gold and crude prices necessarily mean that India's current-account deficit problems recede, or it would largely depend on rupee levels?
Well, there are two aspects. I mean, if the decline is sustainable, yes, it will result in an improvement as far as the current account balance is concerned. But what it means for the rupee is also going to be a function of what happens to capital flows. Don't forget, in the last decade, some of the years in which rupee was under the greatest pressure to appreciate were actually the years when the current account deficit was worsening, simply because the volume of capital inflows was so much greater. Apart from that, I think one of the areas when thinking about the rupee that gets irresponsibly overlooked is what's happening to inflation differential. India is a high inflation, low growth economy now, and the currency needs to adjust to reflect that inflation differential, and so far that is not really happening, and I think that just is going to be an important headwind down the line.
Rajiv, I distinctly remember last time when we interacted, your target for rupee was about 57 to 58. Do you still have that target, or based on the way our commodity prices have moved, you would like to change your target now?
Well, it is still one of the most vulnerable currencies in Asia. I mean, Indonesian rupiah is another one. I think in the very near term, it's more of a stable, slight strengthening bias, but I think the upside is going to be fairly limited. The bigger issue is going to be, later in the year, when several factors, including at least our expectations of an improving growth profile globally, dollar strength, and expectations of what is likely to be in 2014 more of a synchronized G3 recovery, all of them begin to have an impact as far as what's happening with dollar rupee. So I would not necessarily ignore that. And equally, don't forget the point I made about inflation differentials. These have to be reflected at some point. There is no magical land in India that some of these pressure points will not apply. There is obviously room for the government to keep attracting capital flows, but bear in mind, while that can offer some stability as far as the nominal exchange rate is concerned, it does not address the underlying inflation differential.
What about growth? Prime Minister's economic advisor expects growth to be at about 6.4% for FY14. You think steps taken by the CCI can help revive the capex cycle and hence growth?
Well, they're necessary but not sufficient measures. I do think the Economic Council's projection is on the optimistic side. My own personal assessment is growth is going to be closer to 6%, and that already includes some constructive measures that, for example, the CCI, etc., is doing. But don't forget, India's economic recovery is going to be protracted, uneven, and uncertain. And don't also forget that, as we step into the second half of the year, the season for political madness will be in full swing.
So, Rajiv, so what are the tailwinds you see for India's growth in FY14?
I think the underlying structural story is still very much there. It's obviously lost a fair amount of shine but a lot of the problems were actually self-inflicted. So to the extent that some element of semblance and responsibility in government policy making comes across, and not just in terms of CCI, but in the broader policy making sphere, that could be something more constructive as well.
What to your mind then are the headwinds to India's growth at this point? What could dampen it?
Well, several. I think many of them are actually domestic in nature. While people focus a lot on commodity prices as such, bear in mind the actual derailing of India's growth had less to do with external factors and much more to do with domestic factors. So to the extent that some of these can, bring about a nice reversal, that would be a welcome change. But I think any such profile is really going to be a question of what happens in the elections and what the subsequent government is able to design and act on.
Right, Rajiv, really appreciate your time and thank you for your robust and wonderful insights.